We are going to continue to talk about the Fed, but what it means to insurance companies, what it means to hedge fund managers, basically to anybody managing risk. Dean Curnutt is with me now. He is the CEO of Macro Risk Advisors. Dean, thanks so much for coming in, talking to us about risk, the risks that the Fed policy and current policy could have on the markets, what people are assuming. What are your clients telling you right now about how they are managing policy here in the U.S.?
Monetary morphine. That's not my term, but I thought it was a really well-described term, a term to describe what the Fed is, a bit of a predicament that it's in. The word was used cautious earlier in terms of this statement, and that's going to be the question: is how does the Fed treat the economy with respect to policy over the next couple of years? This end of 2014 pledge, at least from our perspective at Macro Risk Advisors, we don't think it's a money good pledge. It's just a lifetime away. In terms of this kind of economy and the kind of monetary stimulus that's been thrown at the economy.
Michael McKay just quoted Keynes, right? When the facts change, I change my mind. So we all know that 2014 is 2014 until it isn't.
Yeah, and so from a risk standpoint, I think the equity market's got to be really concerned that even as the economy actually does better, if Fed policy ceases to be the crutch that lifts the markets, we could have a bettering economy and a worsening stock market. And then the bond market, I think, has got to have real concern, because Bernanke's pledge, the end of 2014 pledge, has actually been really fully discounted into the market. If you look at Fed funds futures, it's almost a sure thing that he's going to keep rates there for so long, which we don't think is viable, actually.
We are going to continue to talk about the Fed managing risk, dealing with monetary policy. Dean Curnutt still with me now here. He is the CEO of Macro Risk Advisors. Dean, before the break, we were talking about how your clients, hedge fund companies, insurance companies, mutual funds, are dealing with the risk that the Fed and its policy represents. One thing we didn't get to cover was, what if the U.S. economic recovery, the pace picks up, and rates do go higher before 2014? How are they preparing themselves for this possibility?
Right. I think, again, the bond market, via the Fed's messaging, the strength of its messaging, has priced the Fed's pledge as if it's a near certainty. And I think, one of the things you have to be careful of is good news could actually be quite bad news insofar as the bond market is concerned. And insofar as the equity market's concerned, higher rates may impede the recovery as well. So there are ancillary businesses and sectors like housing, for example, interest rate sectors that, you also have to be careful if you're anticipating higher rates.
Dean, watching this world of risk and analyzing it as you do, I know you have a few head scratchers, things that are even testing your mettle.
Yeah.
I want to start by looking at one of them, which is, you actually gave us a chart here, U.S. 5-year sovereign CDS spread. And this, you say, if we look at this pattern, and we do, of course, have the graphs so our viewers can follow along with it as well, what about this chart shows a kind of anomaly for you?
Sure. This is one of the things that makes you go, right?
Yeah.
It's
sorry we didn't have the music.
It's just incongruous with what we see and read, which is a dysfunctional political process in the U.S. and just a host of things to get through towards the end of the year in an election year.
So just to remind people, people buy CDS as a sort of insurance policy, and you're saying the fact that the price is going lower doesn't make sense to you? Right.
So again, no one's predicting the U.S. will actually default. But what you can use a sovereign CDS contract for, and of course it's not for an individual investor, it's for an institution, sure. But what you can use it for is to speculate that risk and uncertainty will increase. And so even absent a default, if more people start looking with skepticism, remember the ratings agencies were very skeptical of the process last year as the U.S. tried to get through its debt ceiling issue. That CDS level in the U.S. could easily go from its current level of 33 basis points, into the mid-50s if last year is any guidepost. And again, we have a lot of things to get through. There's the Bush tax cuts that are going to be reversed if nothing's done. There's the payroll tax cut. There's a lot of things that need to be done legislatively, and we have a very dysfunctional, polarized Congress. So you feel like this should be higher now, and it sounds like you're saying it will be higher later when everybody else kind of focuses and pays attention. Yeah, that's the view. You also are telling me that gold is a little confusing. And again, of course, we have a chart so our viewers can follow. What is it about the way that gold is trading that's confusing to you? Sure. Well, gold is the ultimate expression of psychology, of risk psychology. And I think it's more than anything an expression of the views on what Bernanke will or won't do. And so what we've picked up on, and this is a little nuanced, but there are options on the GLD, the gold ETF, and the June expiration for those options is June 16th. And there's a quarterly expiration for options, which is June 29th. And the next FOMC meeting is right dab in the middle of the two. And so we think it's really interesting as a spread trade to sell the regular June options and buy the quarterlies. And what you're doing is you're speculating that that next FOMC meeting in June could create a lot of volatility in gold, depending on what the Fed says.
We often refer to gold as the fear trade. Some people have written in and said it's not the fear trade, it's the fatigue trade. Everyone's just sick of the Fed. I guess the people who are critical are very critical.
Yeah, I think this is going to get to be a very interesting time for gold. It's been really, for GLD, it's been stuck right around that 160 level. If the economy takes off, rates go higher, people are really going to get tired of the gold story. I think a lot of what's keeping gold higher is this view that Bernanke will come back and back and back. So if he does, I think gold has another nice leg up, and if he doesn't, I think gold could go down. So from our view at Macro Risk Advisors, it's setting up for a volatility trade.
Speaking of volatility, I know euro implied volatility versus some of the average debt that's being sold right now in Europe, particularly Spain, is something that's crossed your radar screens as well. And why is that?
So we're constantly trying to find tail risk hedges for our clients, and most of our clients are in the equity space. Out of the money put options, because there's so much focus on buying them, they tend to be pretty expensive. So what we try to do is find other hedges that may not be as expensive. And in the euro, the volatility is sitting in the 10th percentile, even as sovereign CDS levels in Spain and Italy have started to rise quite a bit again.
I just want to put this chart back up again because you just mentioned the level and it was there in yellow, so people can see now the euro implied volatility, as you just mentioned, at the 10% level, but yet you have protection against default, the price of protection against default in Spain and Italy going much, much higher, and you say there's money to be made in the difference between the two?
Well, we wouldn't suggest the spread trade. We would just say that what's happening in Europe, especially given some of the growth shortfalls that we're seeing emerge in Spain, Greek just came back and said it's going to have a really tough year. This view on austerity, it's not going to, we don't think it's going to work in terms of creating the growth that's necessary to pay back the debt. So we see these sovereign spreads rising, even as euro implied volatility, the options don't really cost all that much. So we think that's a really nice tail hedge because we think the euro situation, the whole issue will get revisited again.
Do you think, Dean, that this is another expression, something of what we're seeing here with the Fed, that there are a lot of investors out there who think between the LTRO, the ECB, the IMF, that Europe will be supported, and that's why that chart looks a little bit funny right now?
That would certainly be the other side of it. I would say that the other thing is that the realized volatility, the day-to-day movements in the euro have been pretty muted. That's not good for the people buying options, so they tend to sell them. But I would say, to the point of everything's fine, we're just concerned that the sovereign levels in Spain and Italy, these are two huge parts of the whole structure. And if they aren't supported, there's going to be huge issues for
And
the
as
euro.
many people have pointed out as well, they accept the concept that one euro city-state or nation, however you want to put it, can be weak. For example, Greece, but that once you have this kind of spreading, going to your point to Spain, which is a much larger economy, going to Italy, which is the third largest bond market in the world, that becomes a whole different ballgame.
And remember the circularity, because the banks, specifically in Spain, loaded up on Spanish sovereign debt in the 2 months prior as a part of this kind of Sarkozy trade via the LTRO. And the banks, the banks are part of this issue as well. So there's a really negative feedback loop that could potentially take place between the weak banks and the weak sovereigns.